Hello and welcome to Stock Watch Live. With the drama the sector has seen of late, Serco's second attempt to lure rival defence contractor Babcock with a potential £4 billion deal was as bold as it proved to be unsuccessful. The deal, if it had gone through though, would have brought together two of the UK defence industry's biggest suppliers. A nil premium, all-share deal would have created a defence services giant with operations that stretched from the UK to the Middle East and Australia. But it was, for a second time, unanimously rejected. Babcock said the board carefully considered the proposal and unanimously rejected it, having concluded that a combination of the two companies had no strategic merit and was not in the best interests of shareholders, customers or wider stakeholders. Serco has declined to comment. Now, I mentioned there had been a lot of drama in the sector. Last January, you might remember, Carillion, one of the Ministry of Defence's biggest suppliers, collapsed. Amey, which manages military housing for the MOD, is up for sale, and Capita, which has a contract recruiting soldiers for the British Army, is also rebuilding itself after a series of profit warnings and contract failures, while Interserve is in the hands of creditors. Nearly a third of Serco's work is in the provision of defence services worldwide, so you can understand why it's on the prowl for opportunities, with so many of its rivals struggling. The MOD is also the biggest user of outsourced services, spending nearly 6 times more than the next largest UK government department. However, Serco is no stranger to controversy itself. It was on the brink of bankruptcy 5 years ago, and shareholders have had a rough time since. Although they have climbed 40% over the past 6 months, currently around the 136p mark, the shares are a fraction of the level they peaked at in 2013, when they topped 553p. But none of this has dented Serco's enthusiasm. Having won its biggest ever contract with a £1.8 billion deal to provide housing for asylum seekers in the UK for the next 10 years, it now has its eye on opportunities created by Donald Trump's decision to expand the US Navy's fleet from 280 to 355 ships by 2034. However, Serco isn't quite at the stage where it can rewrite its past with positive news here on in. There is still that investigation by the Serious Fraud Office for overcharging the Ministry of Justice for the electronic tagging of offenders that's still hanging over it. So next week's trading update should make for interesting reading. Broker Peel Hunt recently reiterated its add investment rating on Serco and raised its price target from 129 to 146p. RBC Capital Markets has upgraded the shares to outperform and raised its price target 10p to 150p. Barclays Capital today remains overweight and it says the shares are worth 155p, while JP Morgan Cazenove is the most bearish of the bunch with a neutral rating and a price target of 130p. Another one to watch out for is Stagecoach full year results on Wednesday. In mid-April, the train and bus operator said it had been disqualified from 3 rail franchise contests because of non-compliant bids, principally in respect of pensions risks. That's referring to the pension regulator's estimates that there's an industry-wide hole of £7.5 billion in the railway's pension scheme. Stagecoach has since gone on to explain that it was disqualified because it was unwilling to take on well in excess of £1 billion of pensions liability. And that, it argues, would have meant taking on unknowable risk and being contrary to the success of the company and the interests of employees, customers and the franchise. In retaliation, Stagecoach has launched legal action against the government, alleging the Department for Transport of breaching its statutory duties, and this is its second such legal action. It's already suing the Department for Transport over the East Midlands tendering contest, along with Arriva, which was also disqualified. Giving a trading update in April, Stagecoach reported further strong trading and positive progress in the UK rail division, resulting in an increase in forecasts for adjusted earnings per share in a trading update for its financial year ending 27th of April 2019. But that was before the latest disqualification. Broker Liberium Capital is the only broker to have updated its guidance since that happened. It's maintained its hold rating, but cut its price target from 165 to 135p. Now, despite the word green being in its name, brewer and pub group Greene King is less than green in the ethical and sustainable sense, at least according to Norway's largest pension fund, which has booted it out as part of its purge against so-called sin stocks. KLP, an Oslo-based fund with $80 billion of assets under management, is selling out of companies that derive more than 5% of their revenue from alcohol or gambling. Budweiser maker AB InBev, champagne group LVMH, spirits maker Diageo and fellow brewer Heineken all fall into that camp as well. With companies increasingly being called on to meet ethical, sustainable and governance requirements, we're likely to see more moves like this. Although, let's be honest, there probably isn't much a brewer can do if an investor takes a stand against companies making money from alcohol. What it can do, though, is ensure that what it does do, it does well and makes investors money. The timing then couldn't be better for the arrival of Merlin Entertainment's Nick McKenzie as chief executive. Greene King shares have been suffering a hangover of late, falling as much as 7% on the back of a pre-close trading update that revealed a slowdown in like-for-like sales over the last 16 weeks of its financial year. Greene King, which posts full-year results on Thursday, has set a series of cost-cutting measures in place and is targeting savings of between £10 and £20 million. That includes paying off its debenture for the Spirit acquisition. It's so far cleared 51% of that, or £393 million. Analysts at Shore Capital believe this could be fully paid down over the next 2 years, and they've also upgraded their 2019 full-year pre-tax profit forecast from £243 to £247 million. The broker expects profits to rise to £253 million in 2020, giving earnings of 67 pence per share. Back in March, JP Morgan Cazenove carried out a UK pub sector review, and while forecasting rising costs, particularly for labour, it said Greene King should be insulated from cost inflation to an extent because of its diversified profit sources. It raised Greene King to neutral on valuation grounds. And that's it for this week. To follow the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.